Save for college or for retirement? Well, it's a question facing many young couples at the crossroads between childcare and future planning, and of course a reflection of just how expensive college tuition is becoming. Joining us now is Ulrich, Family Wealth Strategies financial advisor. This is part of our Financing Your Future series brought to you by Synchrony Bank Savings. So Aaron, good to see you here. Obviously a lot of people wondering, they're trying to decide, you have that guilt. Should I be putting in more for my child's college? Or, you have retirement approaching too. How do you figure out which one is the best approach?
Yeah, it's a big question. It's a big deal for working families. They have two things they want to accomplish. We want to take care of our kids and we want to take care of ourselves. The conversation usually starts with the idea that there is not a loan for retirement. Okay, there is loans. There are grants, there are scholarships for college. There's no scholarship for retirement. So we've got to be really aware of what the risks are when you're dividing up your family's finances.
But couldn't you simply take out like a personal loan or perhaps a home equity loan in your elder years if that's something? Wouldn't that be an alternative as well?
It'd be an alternative. I don't think it's a good alternative. I don't want my clients looking for loans and trying to finance retirement. We want to go, and most of my clients that I work with, we work with a lot of folks who are in retirement, taking retirement income. And for most of those folks, they don't want debt when they're retired. They don't want to be trying to take the equity out of their homes. And so those decisions that you make early in life are what can set you up for a quality retirement. And if you're choosing to divert some of your family finances into college funding, you could possibly be doing that at the risk of not saving for retirement during some pretty key working years. So it's not an easy decision. It's a very personal decision. And families, our clients, we want them to understand the rules. We want them to understand what options are available to them, whether that's a 529 or how they're going to invest that money. But absolutely, if you're investing for college, saving for college, at the expense of saving for retirement, you could be doing yourself a very big disservice. Now, I'm biased. I'm a retirement planner. I don't consider myself a college finance planner, but I'm thinking about folks when they get to be 60, 65, 70 years old. We want to make sure that they have enough to take care of themselves.
So I want to talk timelines here because some people have been very good, had a 521 set up before their kid even, opened their eyes in this world. Others are perhaps maybe you have a 10-year-old and you're starting to panic a little bit. In terms of timelines, how should you approach then saving for college?
Yeah, so that's a great question. The 529, just so the viewers understand, that's a state-specific tool. So there's a lot of them, and it can get confusing. So you want to look at the rules for your state. Also, in the case of if it's a grandparent saving for a grandchild and the child lives in a different state, there could be different tax rules for that. So you want to be sure you understand the state rules. But your question was about timeline. When you're saving for retirement, you're in your 20s, 30s, 40s, that's a 30, 40 year, that's long-term investing. In your example, saving for a 10-year-old, well, for college, that's an 8 to 10 to 12 year time frame. That's naturally a shorter time frame, which limits the amount of growth that you're going to be able to get from any investment, right? The best investors in the world can't do as well in 8 years as they can in 30 years. And that's just the limits of what the markets do. And so you bring in some other factors there. The time frame is huge, and your personal risk tolerance. What if the market's down on the day the kid graduates from high school, and that's the year the markets were down and all of those gains went away? Additionally, with a 529, it gives you a tax break on the growth, right? So that's a good thing, the same as a retirement account. However, you only have 8 years to grow it. So if you don't get a lot of growth, that 529 may not be the best vehicle for short-term savings.
You certainly raised some interesting points there. And the timeline thing is very important. I know a lot of people might be hitting the panic button as we speak. A big thank you there, Ulrich, their financial advisor at Family Wealth Strategies. Thank you for joining me.